Hey guys, what's up? My name is Justin, and in today's video, I'm going to be talking about how to invest in the stock market for beginners. For me, I've been investing for the last 10 years, and I've done pretty well, and I've made a lot of money investing in the stock market by following these tricks, and I've really boiled it down to 5 main things that you guys need to pay attention to. I put a ton of work into this video, and if you guys get value out of this video, go ahead and hit that like button and subscribe. So let's go ahead and get into it. So the first point I want to bring up is you need to make sure that you don't wait for stocks to crash. A lot of people talk about the stock market crashing and how there will be a recession soon and you should wait, but I'm going to tell you why that is not correct, why you should not wait for a stock market crash, and why you should just start investing today. So this kind of goes back to a very important principle that you learn when you start investing in stocks, and that is time in the market beats timing the market. And what that basically means is that stocks over long periods of time always go up. And so it's better to be in the market, because if you're not invested in stocks, then you don't get any benefits of long-term appreciation. So they showed that over a 50-year period, stocks had negative years only 15 times. That means a majority of the years, stocks went up. So if you were waiting for a negative year or a recession to put your money in, well, you would maybe have to wait a long time. They also showed, this is actually interesting, I didn't put this in the slides, but they did a research study and showed that over, I think it was they studied 7,500 trading days over a 30-year period, and they showed that 95% of the gains occurred in only 90 days of trading. So basically what this means is by not investing today, you are missing out on future gains. Also, stocks go up and down based on future events. So if you try to guess when a recession is going to happen, there's no way of knowing when it's going to happen because you can't tell the future. If you could predict the future, then you would probably make quite a bit of money investing in the stock market. But no one can predict the future, so it's best just to start investing today because no one really knows what's going to happen tomorrow. That is my first rule. Don't wait for the stock market to crash. Go ahead and start investing today. So this is a slide that basically shows that the stock market keeps going up. In 2017, they put news articles out saying the S&P 500 hit record highs, and then in 2018, again, the S&P 500 hit record highs, and yet again in 2019, the S&P 500 hit record highs. So every single time you see a news article that says that the S&P 500 or the stock market in general has hit all-time highs, and then they say, can it keep going up? Yes, it should. It can. Now, does that mean that in 2020 it is going to keep going up? I don't know. No one can tell you that. However, I can tell you that if you invest in 2020 and the stock market does go down, you're not going to lose money unless you sell. And we're going to get into that later. That's one of my other rules of investing that I'll go over in this video. But 2020 is a great year to start investing, and ignore all of the talks about recessions and other things like that, and go ahead and get started investing today. Here's some quotes from Warren Buffett on market timing. He said, in the 20th century, the United States endured 2 world wars and other traumatic and expensive military conflicts, the Depression, a dozen or so recessions and financial panics, oil shocks, a flu epidemic, and the resignation of a disgraced president. Yet, through all of that, the Dow rose from 66 points to 11,497 points. A lot of things happen in the world, and there's a lot of chaos, and you can say that, oh, stocks are going to go down because of this or that. And while stocks might go down in response to world events, they go up over long periods of time. Something else Warren Buffett said was, the one thing I will tell you is the worst investment you can have is cash. Everybody is talking about cash being king and all that sort of thing. Cash is going to become worth less over time, but good businesses are going to become worth more over time. So here's the bottom line on that is over long periods of time, cash loses value while stocks gain value. So if you're sitting in cash or you're not invested, then you're missing out on making money. And that's basically what Warren Buffett is saying here, is get invested sooner rather than later and stay invested for long periods of time, and you're going to do really well for yourself and make a lot of money. A good way that you guys can get invested today and not worry about if you're putting all your money in right before the stock market crashes is using a method called dollar cost averaging. This is where you invest a set amount of money into the stock market on a regular reoccurring schedule. So for example, you might invest $50 a week into the stock market, let's say every Monday or every Tuesday or every Wednesday, or you might do it once a month. But you need to make sure this works best, dollar cost averaging does. It works best to keep investing whether stocks are up or down. So you need to keep doing it consistently and ignore the price of the stock market. The benefits of doing this are that you will avoid putting all your money in right before the market crashes, and you're more likely to start investing sooner rather than waiting until later. And it helps you build good habits of saving and investing. So this is a method that I use every single Monday. I contribute to my Roth IRA and I contribute to my individual investment account that I have. I can show you guys that portfolio at the end of this video. I spend probably 6 to 8 hours a week researching stocks and keeping up with my investments, and I've done really well picking individual stocks. But we'll get later into the video, we'll get into what Warren Buffett recommends and what I also recommend if you are a beginner in the stock market, what you can do and how you can pick your investments. But we'll get into that later in the video, so let's keep moving. Rule number 2 of investing in the stock market for beginners is don't sell your stocks. This kind of piggybacks off of point 1, but selling means you are no longer invested in the stock market and you are potentially missing out on future gains. If you leave money invested, guys, it will continue to grow, but as soon as you take it out, you're not participating in the long upward trend of the stock market. So you need to leave your stocks invested and don't constantly be buying and selling. It's okay to constantly be buying, that's fine, but don't constantly be selling. And to prevent yourself from constantly selling, make sure you're only buying stocks you know you're going to hold on to for a long time. What I recommend for this is try holding on to the stocks you purchase for at least a year. If you can do this, if you can hold on to your stocks for at least a year, that means that the gains will be long-term capital gains and you're going to pay a lower tax rate on them. And it's good to keep you guys disciplined, you know, because when I buy a stock, I look at it and I say, okay, is this a stock that I can hold for a year? And if the answer is no, then I probably shouldn't invest in that stock. And if I do make a bad investment, then I can sell it before the year is up. But, you know, I learned my lesson. I say, you know, I made a bad decision. I made a bad investment decision. I'm going to sell this before the year is up, and I'm going to learn from my mistakes. But I really try hard to pick good stocks that I know I can hold on to for at least a year, because a year is not really that long to be invested in a stock. Here's another point. If you must sell a stock, whether you, like I just said, if maybe you made a bad investment and it's losing money, don't hold on to that stock. Go ahead and sell it and learn from the mistake. And if you do need to take money out of your investments, don't sell your stocks that have gains, because as soon as you sell a stock that has gains associated with it, you're going to pay taxes on that stock. Whereas if you would sell the stock that has a loss, you get a tax benefit, and you want your stocks that have gone up to keep going up. Last thing you want to do is stop your gains and sell a stock that you've made a lot of money in, because stocks that go up tend to keep going up. So we want to make sure that we're keeping our winners and selling our losers if that's something that we need to do. Now, I'm not saying you need to sell a stock every single time it goes down. It might be the case that you want to buy more of that stock, but if you absolutely have to, sell some stocks because you need the money, sell your losers first and leave your winners alone. That's worked out really well for me, not selling my winners. I had a stock that was up, I think, 150 or 200%, and I did everything I could to not sell that stock. And because of that, it's now up over 450%. So if I would have sold, I would have missed out on, 200% of gains. So here's some Warren Buffett quotes on buying and holding onto your stocks instead of constantly selling them. He says, you can't produce a baby in 1 month by getting 9 women pregnant. That's actually pretty funny. But yeah, you can't rush things in the stock market. And I think Rule 5, we talk about that in this video where, your emotions play a lot into that. You just want to be patient with your stocks. Holding onto your stocks is the best way to make sure that you're making money in the stock market. Something else he says is, if you aren't willing to hold a stock for 10 years, don't think of holding it for even 10 minutes. I just said make sure you hold a stock for at least a year before you sell it. Warren Buffett takes this to a whole new extreme because he's Warren Buffett, and he says if you can't hold it for 10 years, don't buy it. I say if you can hold a stock for a year, you're doing way better than most people who invest in stocks. Most people who invest in stocks, especially beginners, get into this habit of buying and selling and buying and selling. And you really want to avoid that. Like Warren Buffett says, if you can hold a stock for 10 years, that's amazing. You should do that. He also says, when we own portions of outstanding businesses with outstanding management, our favorite holding period is forever. So that reiterates what I just said. You want to buy investments that you can hold for forever or your whole life. That's the type of stocks you want to invest in. He also says buy companies with strong histories of profitability and with a dominant business franchise. Again, you want to look for strong companies that will remain being strong companies for a long time. The bottom line on all these quotes from Warren Buffett is that it takes time to make money in the stock market. You can't rush things, and we'll get into that in another point. If you try to rush things, you're going to make some mistakes and some bad decisions, and you might lose some money. Just be patient, and it takes time to make money. This next rule is don't try to get rich quickly. The last point was talking about buying and holding solid companies for long periods of time, and this is kind of the opposite of doing that. When you try to get rich quickly, you tend to not invest in things you understand. You really want to stay away from investing in things you don't understand. Definitely don't invest in things that you know are risky. Guys, don't try to rush things. This goes back to the last point with Warren Buffett's quote about, it takes 9 months to have a baby, and it doesn't help things by trying to speed that process along. It's going to take 9 months regardless. And you can try to make money in a quicker amount of time in the stock market, but it's going to lead to some risk-taking on your part, and you're going to be way better off if you just buy solid companies and hold on to them for a long period of time. Investing should be like watching the grass grow. It shouldn't be exciting. If investing is starting to feel exciting, then you're probably doing it wrong, and you're probably speculating or buying risky things that you shouldn't buy. You want to make sure that you're buying investments that let you sleep at night without worrying about what is going to happen to them. Being patient and letting the market go up over time is your best bet. Here's some Warren Buffett quotes on taking unnecessary risks and speculating. Risk comes from not knowing what you are doing. That goes back to only buying stocks that you understand. He also says, buy into a company because you want to own it, not because you want the price to go up. Buy companies that you like, that you understand, that you know what they do, and that you just like owning. I think that's a great place to start for most people. He also says, keep things simple and don't swing for the fences. When promised quick profits, respond with a quick no. You want to make slow progress to your goals. You're not trying to get there really, really quickly. You're not trying to double your money as quickly as you can, as fast as you can. You're just trying to make slow, steady progress. Because if you can do that over long periods of time, you're going to make way more money than trying to do things quickly and taking unnecessary risks. Investors should remember that excitement and expenses are their enemies. And I really like this quote because it hints at excitement. If you're getting really excited and it's high stakes, then you're probably gambling. You're probably not investing. Remember, investing is meant to be boring. He also says half of all coin flippers will win their first toss. None of those winners has an expectation of profit if he continues to play the game. That first coin flip, that first day trade, it's 50-50. The first day trade, you might make a lot of money. And the second one, you might make a lot of money. And the third one, you might make a lot of money. But all it takes is a series of bad luck and you could lose all your money. He says that if you keep playing that coin flipping game and day trading, that over a long period of time, you're basically guaranteed to lose. The bottom line on all of this is investing in risky stocks might work well over a short period of time, but it always fails over the long term. Risk taking might work for a short amount of time, and there might be people that it works really well for. 1% of the people might make a ton of money doing it. But for the majority of people, it's going to end very poorly, and Warren Buffett doesn't recommend it, and I don't recommend it either. This is rule number 4, and that is don't check your stocks every day. You guys don't need to check your stocks every day. The stock market is going to go up or down. It's going to do its thing whether you check your stocks or not. It doesn't require any input from you to work. The more you check your investments, the harder it becomes to resist selling when the market drops. Now, if you're checking your stocks every single day, you're probably going to get a little OCD about it. Oh, look, I'm up 10%. The next day, oh, I'm down 5%. And you're going to be more likely to panic when the stock market drops. This is what's great about the stock market is whether it goes up or down, you don't do anything. If you just hold your stocks for a long period of time, they're going to go up and it's 100% passive income. It doesn't require any work on your part except to be patient, not sell when the market goes down, and to consistently put money in and hold stocks for a long period of time. If you purchase stocks of large, well-known companies, then there's no reason to check your stocks every day. You want to make sure you're buying large, well-known stocks in well-known companies because it's going to resist your urge to constantly check your stocks and you're going to be more likely to hold on to them over the long term. Don't check your stocks every day. Turn off your computer, live your life, and you'll be happier and you're going to make more money over the long run. Warren Buffett, these are his quotes on not checking your stocks constantly, and I think it's really kind of all about emotions. The ability to have self-control and to not be OCD about your stocks or not become addicted to trading or looking at your stocks. This is what Warren Buffett has to say about all of that. The most important quality for an investor is temperament, not intellect. The temperament to not look at your stocks. The temperament to turn off your computer and go and do something else. That's really important. He also says what you need is a temperament to control the urges that get other people into trouble in investing. He talks a lot about fear and greed. If stocks go way up, great. You're making money. That's awesome. And if stocks go down, then you know you're not going to lose any money because you know you're not going to sell. Controlling your emotions and controlling that fear and greed is really important. He also says don't watch the market closely. You don't need to look at what's going on in the stock market every day. Stocks, like I think it was earlier, and I said one of his quotes was, all these bad things happened throughout the world in the 20th century, but stocks still went up. So there's always going to be crises. There's always going to be things that happen in the world. Be patient. Don't be fearful. Just wait it out, and the stock market will keep going up. He also says the stock market is a device to transfer money from the impatient to the patient. So again, be patient. Don't be impatient. And I think the ability to be patient does tie into the ability to not constantly look at your stocks. So here's the bottom line. Thinking long-term and being patient is the only guaranteed way to make money in the stock market. Guys, if you can buy high-quality companies and hold on to them for a long period of time without selling, you're basically guaranteed to make money. And here is the last rule, and this isn't really a rule, it's just something I really want to point out for beginners, because I'm sure that you've heard this all the time, but investing is not gambling, okay? For people that tell you investing is gambling, they don't know what they're talking about. There are only 2 ways to lose money in the stock market, and that is selling a stock at a lower price than what you bought it at, or buying a stock that loses all of its value. And we know how to reduce the risk of buying a stock that loses all of its value, and that is don't buy risky stocks. If you buy Apple, the chance that Apple is going to go to 0 overnight or in a month or in 6 months is highly unlikely. I'm not going to say it's impossible that Apple goes to 0, but if Apple is going to go to zero, you're going to have probably years to get out of the stock. Whereas if you buy really small stocks, they could drop 35, 40, 50% in a single day. Apple is not going to drop 50% or even 35% in a single day. It's probably not going to happen. The other thing is gambling is based on luck, whereas buying a stock means you own a small part of a company. So gambling is just like throwing money on a table and trying to guess what happens, or it's not really tied to any physical thing. It's you're just putting money on the table, and if you lose, then your money's gone. Whereas when you buy a part of a company, or when you buy a stock, you are buying a part of a company. You're buying part of something that makes money and is something physical. It's completely different. Also, if you buy a lot of stocks, your risk of losing all your money goes down. And the example I had with Apple earlier. Okay, what if you bought 5 stocks like Apple, or 10 stocks like Apple, or 100 stocks like Apple? You're basically guaranteed to not lose all of your money. For example, the Vanguard Total Stock Market ETF, which has a ticker symbol VTI, allows you to buy 3,500 publicly traded companies all at once. The other thing is investing is meant to be boring, whereas gambling is usually really exciting until you lose all your money or you lose some of your money. Investing is not meant to be exciting. It's meant to be boring. You just put money in and you wait for long periods of time, and then voila, you have more money when it's all said and done. To wrap up this video, I found one of Warren Buffett's quotes, and I think this is really a good practical quote. It's great practical advice if you're a beginner in the stock market and you're wondering, what do I do? What do I invest in? So here's his quote. If you invest in a very low-cost ETF and you don't put all your money in at one time, but instead average it in over 10 years, you'll do better than 90% of people who start investing at the same time. He's basically saying buy an ETF of all the stocks, hold on to them for a long time, and consistently put money in over that period of time, and you're going to do better than 90% of everyone else who invests. That's, I think, really good advice for you guys that are thinking about starting to invest. So what are some next steps? Well, you need to make sure you open a brokerage account. That is an account that gives you the ability to buy and sell stocks. Then, like Warren Buffett recommends, buy an ETF or a mutual fund that tracks a lot of stocks like the S&P 500 or the total stock market index. So you're getting exposure to a ton of different stocks. Also, buy stocks consistently on a regular schedule. And then, once you've done all that, you can basically forget about your investments and live your life knowing your investments are making you richer without you doing any work. And that's really the beauty about investing. That's the video, guys. I hope that all of that was informative to you. Hit that like button below, and I'll see you guys next time. Thanks.